Hi everyone, and welcome to The Hash, your daily breakdown of all the latest and greatest in crypto and culture. My name is Naomi Brockwell, and I'm delighted to be joined by our other wonderful co-hosts. For today, we have Ben Powers, Jen Sanasie, Will Foxley, and CoinDesk's new Deputy Global News Editor, Zack Seward. Welcome to the show, guys. Yay!
Hey.
So we're going to kick off the day by talking about some huge news. The Bitfinex Tether lawsuit may finally be over. Zach, tell us about that.
Yeah, sure thing. So Bitfinex and Tether, sister companies under the auspices of iFinex, have settled their 22-month-long lawsuit with the New York Attorney General's office. This stems from an allegation by the AG's office that Bitfinex improperly covered up an $850 million hole on their balance sheet relating to one of their payment providers, Crypto Capital, that that had its own problems. But this sort of brings like a nearly 2-year-long saga to sort of just a quiet close. So they settled for $18.5 million. And I think the question here today is, does this, does the cloud that is hung over crypto as a sector relating to Tether and its collateralization issues, does that cloud go away, or is it more of the same? And I think I'm going to toss this to Will for the first take. What's your read of the New York AG's settlement with Tether here?
Well, I'm sure the Tether FUD's not going to go away. I can tell you that. I think that the Tether FUDers are pretty deep in the hole with this stuff, and they have some arguments out there that I don't think are going to go away with just this follow-up from the New York AG's office. I think that the New York AG put out some claims in the piece itself, and they said that though Bitfinex didn't have Bitfinex claimed that there was no wrongdoing on their part. The New York AG did not necessarily agree with that, and they did end up fining them. I think the story kind of goes to where the information from this case will end up. I think it could end up in SEC hands or DOJ hands, which could just prolong this. Doesn't seem like there was any information that we got out of it right now that puts the New York AG's case in a very good spot. And it seems like Tether kind of came out on top here and iFinex came out on top here. As it affects the larger crypto market, I think it's a really big bonus for Bitcoin and really big bonus for the cryptocurrency market in general. This has been, like you said, Zach, like a rhinoceros or an elephant on top of the whole cryptocurrency market's back for years with allegations of pump and dump from Tether, which is the largest stablecoin in the market. So I think for the cryptocurrency market in general, really big bonus. And then also for Tether, iFinex, Bitfinex, this is huge news for them and a win for them.
So quick TLDR on what came, in addition to the settlement, Bitfinex and Tether agreed to quarterly disclosures of what is backing Tether for 2 years hence. So I think that degree of transparency is certainly something that these companies could have been better about in the past. And I think that's a clear win for people on both sides of this debate as to whether or not those transparencies will give additional credence to these markets. I saw Ben and I saw Naomi. I'm going to go to Ben first and then Naomi.
We're going to fight it out.
Do it. Let's go.
Exactly. No, I think that, to me, the transparency reports and the reporting for 2 years is going to be the big takeaway here, just because it's going to make more information readily available. And that really seems to be what was at issue here in a lot of different ways, is that there was not enough information. But I think there's still an open question about who's going to be, auditing those, reviewing those. There wasn't information about that in the settlement, to my understanding. And so that's my biggest question coming out of this. Is this just going to be stuff Tether gives up to the AG, or is it going to be a third independent party doing this that perhaps might not have quite as big a stake in the game? But Naomi, what were you going to jump in with?
Yeah, so I want to provide some context for people who are recent to the space or not really around when the whole Tether FUD started. So Tether and Bitfinex, I mean, you've got to backtrack many, many years before crypto companies had any sort of banking relationship, right? And back in 2017 or earlier, it was really hard to have any sort of banking relationship. Banks were shut down all the time. As soon as someone found out you're involved with cryptocurrency, they were just shut down. So it was very difficult. Like the reason Coinbase flourished is because they got a secure banking relationship, and that really benefited them. Other places had to go through kind of proxies. Now, Crypto Capital was this very famous proxy, very kind of shady organization. No one really knows who runs it. They've been accused of fraud and all of these sorts of things. But basically, they were the proxy that like almost everyone in crypto was using. And so what they would do is they would set up all these shell accounts at bank accounts all over the world, and crypto companies would use them as their holding. Now, the reason that Bitfinex ended up with this $850 million hole was because in Poland and in other places, law enforcement seized a bunch of Crypto Capital accounts. So Bitfinex literally lost access to all of their funds. They weren't being charged with, fraud or money laundering or any of that. They were just holding their money through this organization that everyone in crypto used to hold their money through, and Crypto Capital had their funds stolen. So the fact that Bitfinex and Tether are run by the same people, I understand that it made sense for them to have that line of capital and say, listen, that's a tiny amount in Bitfinex's lifespan. We're going to be able to pay that back real quick. And so they extended this line of credit, and so Tether was able to hold the fort so people could still get access to their money on Bitfinex. You know, there was no shutdown. People still had access to their accounts. Now, the issue is that Tether always said that it was backed one-to-one, but they did change the language on their website. I think it was 2019. They said, we're backed by debt instruments as well. And I presume that is the liability that they held where they gave the loan to Bitfinex. But I think that, I mean, all this, like, that's just a bit of context for people, but it is super hypocritical when I think of the New York Attorney General going after Bitfinex, which I think was only like at its lowest point was like 75% collateralized is what they estimate. When you have banks in New York City that are under 10% collateralized, and that's totally fine. And so they're saying, well, it's because they weren't transparent about the reporting. And I understand that. I think that's great. But I wish the New York Attorney General would be a little bit more consistent in, like, if they don't like fractional reserve, then maybe go after some of the nations that are doing it too. Like, if this is an issue we should be talking about, let's talk about it across the board, not just in the crypto space. And furthermore, Bitfinex wasn't even operating in New York. They're not allowed to, right? So they shut down when the Bit license came into play. So the fact that the New York Attorney General says they have the jurisdiction to go after Bitfinex, which isn't based in New York, it doesn't have New York customers apparently. I mean, I just think it's a whole lot of crock, and there's something else going on there with the New York Attorney General. But that's my hot take, Zach.
Yeah, that's a good take. Yeah, I just want to zoom out a little bit, maybe just like the information environment around this story. When this story came out, it seemed like there were little nuggets in the reporting and in the filing itself that appeased both sides of this big debate. Right, there was a famous nugget in the filing that said for a portion of 2017 they were not banked at all. On the other hand, if you look at the substance of the report, there's no admission of wrongdoing on the part of Bitfinex and Tether, and there's no real. It doesn't seem like the collateralization issues are ongoing outside of that period. So basically, like, this story hit, and I think like people were sort of expecting resolution one way or the other, and in some way we have it both ways now still, where the questions are still lingering, and the believers that that Tether and Bitfinex are manipulating the cryptocurrency markets, and the believers that, hey, this isn't a big deal, the market doesn't care, there's 32 billion Tethers in the world now, and this has grown over the duration of this long court case. There's no resolution, and I don't know if that's just like a alternate set of facts type thing, or like speaks to the nature of social media and information sharing, but to me that's sort of what it feels like. Kind of feels like a big shrug, like a shruggy, like, okay. There's not much clarity one way or the other. So I'm just curious if you guys felt that, if you saw that, or if I'm off base there. Naomi, I saw your hand shoot up.
Yeah, I will just mention that there's always going to be an element of trust with the issue of stable coins, whether it's Gemini, that claims they're fully audited, whether it's, DAI, which you're banking on mathematics for it to happen, Tether, which people view as more shady. There's always an element of trust. Even with audits, it's very difficult. Like, the reason Tether couldn't get an audit like years and years ago is because no one would do it. They looked around. They pled with people, please, can someone please audit us so we could put this to rest? And no one would, because it was such a murky area, super gray in terms of legality reality is no one wants to put their rubber stamp on it and say, yes, we agree with this, because like even if you have the amount of money at a certain period of time, maybe that money was taken from somewhere else. Like it's just really difficult to kind of see through these murky waters. So I think this element of trust in the crypto space, it's it's problematic, but it's innate in stable coins. So I think it's going to persist.
Cool. And the market, Bitcoin is down about 10%. Second day of a bit of a sell-off. Unclear if that's related to this this settlement or not, but lots of assets are down across various markets. So if you're looking for a clear market sentiment, I don't know if we've seen one yet following the announcement of this settlement. With that, let's shift gears deeper into the Bitcoin world with Jen. I hear that Sailor Mania has flared up again. What's up?
Yeah, well, Michael Saylor was on CNBC's Squawk Box, and he had a bit to say about Bitcoin. Let's take a look.
Bitcoin's not for spending. It's not really a currency, so sometimes people get confused, like the Janet Yellen quote. They're thinking they're going to move it around in order to pay for coffee. Now, Bitcoin is for saving. Bitcoin's got a compound annual growth rate nearly 200% for the past decade. And so if you want to save your money for the next decade, it's logical to do one transaction. Put all your money in Bitcoin and wait for a decade and wait for it to go up.
All right. So he said, put all your money in Bitcoin, wait for a decade, and wait for it to go up. I think he's echoed some of the things we've said on this show as using Bitcoin as a store of value. But when you hear that quote, when you hear someone like Michael Saylor say, put it all in Bitcoin and just wait for a decade, what do you think? Naomi, I want to start with you.
I agree with him. Bitcoin is not for spending. I don't spend my Bitcoin. I use other coins that are a lot cheaper. I'm not going to use something that's Ethereum based because transaction fees are too high. I'm not going to use something that's Bitcoin based. Transaction fees are too high. So it doesn't make any sense to send it. And people realize that. That's why they're not. They're not buying their coffee with Bitcoin. They're saving it. I think that's a solid move. Will, what are your takes on this?
This is giving me flashbacks of last week talking about coffee.
That's great. You better take your fighting mitts on.
Did you buy anything other with Bitcoin other than coffee and pizza? Because we could really diversify what the shorthand is here.
No, okay, so I'll try to steer clear. I think, like, even on a tech level, Michael Saylor's point is exactly correct. If you're looking at what blockchains are and what cryptocurrencies are, they're peer-to-peer networks for moving money, which are like incredibly inefficient, especially at scale. Once you get to the size of Bitcoin, get to the size of Ethereum, it just costs too much to propagate a transaction across thousands of different ledgers, which is what a cryptocurrency is. There's thousands of accounting ledgers, and you're moving that value across all those ledgers. Something like Venmo is way cheaper. And so I think he's totally correct here in saying that, like, if you buy Bitcoin, expect to hold it for a long time. It's a savings mechanism. It's supposed to be a new digital clearinghouse of sorts. So I think he's spot on.
Venmo, Venmo. Sorry, I just got to bring it back to this. We have all these options out there. We have all these options for cryptocurrencies that give people back power over their money, financial sovereignty, and you say, well, you could use Bitcoin or Venmo. What about all the other options out there that give people back control over their money?
No, so I think that kind of misses the whole point of peer-to-peer propagation. So something like Venmo is based on trust in courts, which, I mean, I trust a little bit more than a 51%
Trust in courts is what got us into this mess, Will. People don't trust the financial system. Robust. They don't trust fiat.
For a while.
That's why. Okay, so the financial crisis. 2008 is the reason that Bitcoin was created, because the government prints money out of thin air. People don't want part of that financial system. Venmo is part of that financial system. What about the alternatives? Why not use them?
Yeah, that's why Bitcoin is around as a larger hedge against those financial systems in case they break. But if you're relying on a smaller coin, if you're relying on a smaller coin to move easy cash around for buying coffee, then you're participating in a network that's incredibly insecure. 51% attacks are a very real thing against proof of work coins. We've seen that with Ethereum Cash or Ethereum Classic, got 51% attacked 3 times in the last 2 years. And if you're participating in that, I mean, that's your choice. I won't stop you from doing it, but I wouldn't do it. I'd rather use Venmo.
So, I mean,
I'd rather have control of my money.
People like an easy binary. It's one thing or it's the other thing. I think the interesting thing about Bitcoin is that it is both, right? It shares a lot of the same attributes as a savings vehicle such as gold, but hey, it's also peer-to-peer electronic cash that is, that gives people financial sovereignty and exists across borders and without control of, outside the control of central governments. So the fact that it can be both is perfectly fine. I think people are voting with their feet and using it as a savings technology, and that's totally fine. But there are certainly large populations around the world that, for various reasons, use Bitcoin, as currency, as it was intended as a peer-to-peer electronic cash system. So, if the use case is moving more towards savings, I think that's what we're seeing over time. That's certainly becoming the case if you look at things like HODL waves and other metrics. But that doesn't mean that it can't also be a payments vehicle. And I think, this sort of, this like stubborn desire for it to be one thing and not the other thing is kind of frustrating at times.
Follow this debate more on Reddit later.
Or in the comments on YouTube. By the way, Will, don't ever read the comments. That was your biggest mistake last time. You never read the comments.
They feel me.
All right, we're going to take a quick break just, to read the mentions. And when we return, the 5-day standoff down under has come to a close between Facebook and Australian news readers. We'll dig in a bit. Thanks.
All right. So we are back with more Facebook news. It was only a few days, but as we see in a lot of these debates, things are shifting quickly. Facebook is back at the bargaining table with the Australian government over their recent law that was going to call for Facebook to pay news publishers for the content news publishers put on them. Facebook essentially took its ball and went home, last week and said, okay, whatever, and cut off news in Australia, international news from being published on the platform in that country. So what the end result was that click-throughs and clicks to Australian news generally fell drastically, which sort of showed the importance of Facebook within that ecosystem. So right now, the Australian government said, okay, we're not going to make you pay for news just yet. We'll have some more time to negotiate those things. But meanwhile, what's lurking in the background is Australia has a mandatory arbitration clause that is sort of a hammer over Facebook's head that says, hey, if you can't come to an agreement with a news publisher, we're going to have a third party independently tell you what that's going to look like. And Facebook has its own little, brought its gun to a sword fight and said, we could just take our ball and go home again. So I'm curious to get initial reactions. Naomi, you and I were talking a bit about this, but hit me with it. What's your thoughts here?
Yeah, I mean, exactly what you said. I don't see what leverage Australia has now that they didn't have before. The fact that Facebook can just take their ball and go home is a huge thing. And, Facebook said back last year when they were debating this bill, they said, listen, you're really undervaluing the value that Facebook brings to the table by providing these click-throughs to your news organizations. And you're trying to extract more money out of us, using the government as a tool to do this. And what you said, you illustrated that you gave us the data that proves that they're exactly right. The click-throughs fell drastically for these news outlets. They're benefiting from people sharing these links on Facebook. We intrinsically understand that. That's why journalists post their link on social media. They post it where the audiences are. They post it where they're going to get the views for their content. And that's why Facebook is super valuable. So really, it's just a case of rent seeking. Rupert Murdoch owns all the print news outlets in Australia, plus a bunch of radio stations, plus a bunch of news stations. But, and so this is clearly for me a case of him using his powerful position to strong arm the Australian government. The Australian government said, oh, all right, cool. And they went along with it. And meanwhile, Facebook's like, I don't understand what leverage you have. And they've proven that they really don't have leverage. So we'll see what happens. I don't know what's going to become of this third-party arbitration thing. Jen, what are your thoughts on the third-party arbitration? I saw your face kind of angry there.
Well, when I first read this story, 5 days ago, I just thought to myself, like, why on earth should Facebook have to pay for news links being shared on the platform? This just shows such a lack of understanding of how people consume news. And as a journalist, I was so upset by it. And this story is just, I mean, we'll wait to see what happens, but it's scary to me because if this does go in favor of Rupert Murdoch, it just points to more situations like this happening all over the world. And I can't imagine what the outcome is there. Ben, I just saw you raise your hand.
Yeah, I think there's so many kind of machinations going on behind the scene here, right? And, for an audience that might be joining us from both the world of decentralization and the more centralized one, I think it's just important to point out that this is a really important example of like how centralized power can function and how it comes down to so few players. Because what I think is important here is, I think this is one more attempt to try and get Facebook to kind of give back some of the wealth and power that it's accrued through these things, because certain news companies have become so dependent on that platform for all of their funding. And that is impacting not only the quality of news, but how many journalists get hired and other things like this. And Facebook is also, basically bluffed and fibbed about the metrics that it can get through, get for companies, through advertising models and things like that. They did the whole, okay, we're going to tweak our news feed, everybody jump in on video. That's going to be our big thing. So, you have places like Huffington Post and others hire whole video departments, lay off tons of journalists. And then Facebook was actually overinflating the amount of views that they were getting on the platform in that regard. So this comes from a whole backlog of mess. I think the connection with the Murdochs here and their shakedown of Google in this and attempted one of Facebook is another level of it. But I think that's some of the impetus behind why we're having this conversation in the first place, and why there is maybe a feeling that Facebook needs to be returning some value to these news companies as well.
This is one of those ones where there's like no heuristic for like who's the good guy and who's the bad guy.
Totally.
So like
Yeah.
I'm hearing all these names like Murdoch and Facebook and like all this people. I don't really know what. I don't know who to root for. I don't know what's going on. I don't like to think about Facebook. I don't go on Facebook. I don't know. I don't know what my take is here, but it's one of those ones that's interesting to talk about because there's no easy answer. With that, I want to throw it to Naomi because she's got an easy answer for staying toasty in the winter, right?
Absolutely. I think we mentioned this on the show a while ago when we were talking about at-home mining. And I was like, oh, yeah, I run a miner. It helps me as a heater, but not much else. So this guy posts a blog post talking about how he actually substantially brought down his heating costs by using miners. And it was a really cool blog article. You can see it up there. And so he had these two different methods of doing this. One of them was just putting a miner in a room, and then the centralized air pump would extract the heat coming out of the miner and help him. And the other one was, setting it outside the house. It's a lot more complicated setting it up, but he would be warming like the outside air. And basically the results of this were that he was able to lower his heat pump's electricity needs by 50%, and half of the costs were also paid for by his mining earnings. What are your thoughts on this? Is this something you guys would ever consider? A lot of people go into solar power and all of these things. Bitcoin miners might be the next big thing. Ben, I'll go to you first. And then
I just
then
have one question, and then Zach, I'm handing right off to you. Can he buy some coffee with those things?
No, Ben.
Just use Venmo, Ben. Just use Venmo.
Zach, over to you, man.
Wow, the trolls have infiltrated the show. We need to get an off. I wanted to know if we can take like a field trip to your mining rig one day, Naomi. If you could just like show us your setup, because I'm curious. Like,
That'd be fun.
I'm just curious what it looks like. I'm curious, like, yeah, how do you circulate?
I didn't go get it. I don't want to get up out of my seat though. I don't want to get up out of my seat because I'm wearing sweatpants, and I look professional and soft. People don't see what I'm wearing underneath. But next show I'll bring it in. It's just a little app miner, the same way that I have a space heater in some of my rooms. Yeah, it's just like a fan generated thing. So the heat that comes out of it is pretty substantial. Like it keeps my toes real nice. And my office where I do my videos, that's really, really bad heating in here. There's just very bad insulation and all of that. I should probably fix that. But instead, just buy a crypto miner, right? And just warm your feet, and it works out the same afterwards. Jen, is this ever something you would consider? Would you consider going into like the at-home mining world to warm your feet? You're in Canada, so, it gets cold there.
Yeah, in Canada, we can always use extra heat, so I am in. When I was reading the story, I was like, "Is this the future?" I know I'm always asking this question on the show, but it just seemed to solve so many pain points that we speak about. So yes, I think it is very cool. I would definitely try it. The setup looks quite complicated, so I think that could be a barrier for just the average person trying to do this as well. But Will, what are your thoughts on this? And before you tell us, I just want to say that I support you.
Support me.
Yeah, I support you in this conversation.
Well,
I am on your side.
All the way from Canada.
It's good. The market's on my side too. It seems Bitcoin's doing pretty well. In regards to mining, I would not mine in my house. I don't think so. It'd be expensive and it would cost, just cost a lot. Heat up my house, I guess. I don't really want that. A lot of people think Colorado's freezing. It's actually pretty nice year round. It's like 300 days of sunshine a year. So I don't know if I'd necessarily need it. An interesting corollary to this story, though, is that a lot of Ethereum miners are now like stripping down old gaming stations to get GPUs and mine for themselves. So like mining is hot for sure in more than one way, I would say.
Haha, nice pun there. I see what you did.
On point.
See what you did there. Yeah, I mean, it's the setup isn't complicated if you just have a miner. Literally, it's just fan forced air onto your feet. These people are doing more complicated things. They got pipes. They got all kinds of stuff. So you can check out his blog if you want to learn more about doing that at home. But coming up after the break, praying trader bots creating havoc on Ethereum. More details to come after the break.
Welcome back to the Hash. So we are turning now to maybe a little spooky story, praying trading bots in the Ethereum dark forest. So just a little background. In September of last year, a really prolific hacker in the Ethereum space called Sanasie published an essay called Trading in the Dark Forest or something to that effect. And basically the idea is in blockchains and in Ethereum and in DeFi, you can send a transaction to someone to create like an arbitrage profit. So if you're trading on, say, DYDX, which is a DeFi trading platform, and you see like, oh, if I make this trade, I'll make a little money. Well, there's bots also lurking in the Ethereum network, and they will copy trade and then bump up the price of the transaction fee and secure the profit before you. This has a lot of negative externalities on the Ethereum blockchain, which a lot of users are experiencing right now. I think this morning transaction fees for like an average transaction hit $40, which is just insane.
Wow.
It's a huge number just to like think about. We're supposed to be able to spend cryptocurrencies for less than pennies, and it's hitting numbers that the average transaction would probably cost. Ether itself was only $80 2 years ago, so it's getting pretty high up there. So I want to pitch this over to Zack as someone who's been covering Ethereum as an editor for the last 2 years. What do you think about these new trading bots that are coming to live?
Well, I just want to know who's behind the bots. Is it known? Is there a known bot master here? What's going on? Who is profiting from this?
Naomi's mining farm is doing it.
Oh, I knew it.
That's right.
No, tell me, Will, who is doing it?
You want me to answer it? Okay, so
yes,
for the backstory, there's a lot. It's basically market makers. So it's called miner extracted value, and miners could technically pull off this arbitrage technique, but really it's bots that a trading firm will set up, and it will just run a script, and we'll just keep watching the blockchain, waiting for these arbitrage profits to pop across the screen, and then they'll grab them, and they net a bunch of money. In January alone, they netted, I think it was 50 million in profit based on some pretty rudimentary research. In the last 30 days, they've netted $100 million. Again, these numbers are probably a lot higher in actuality just because a lot of this research is based on like estimates that can be a little bit off. But I want to toss this down to Ben.
Yeah, I think I covered something, a report on this from Zengo in December that was kind of breaking down, how advanced these bots were. And they kind of set their own honeypot of transactions with varying levels of profit to be gained. And they found that these bots were really good at differentiating between like how much money they were going to make and see if it was actually worth it. And they were doing this not just with ETH, but across a variety of other arbitrage opportunities. So they're pretty advanced and it's really interesting. But I think this is part of the reason, too, that you're seeing, we've talked about privacy in the real world, and we've talked about privacy with Bitcoins and other things. This is why you're trying to see a lot of different sort of efforts made to improve privacy on DeFi and others, because it can help prevent against this sort of thing. So those are developments that we're seeing come across the line. But I think, Will, just the amount of money that you're mentioning, it's pretty staggering, even the last 30 days that this is still happening, because bots are always going to work quicker than people.
Yeah, absolutely. You see it in traditional... Yeah, you see it in traditional finance as well. I mean, these things are rife throughout any financial industry, not just crypto. When you put a trade in with a larger extent or trading house and they front run you, and it's always like they're accused of this, they always deny it, right? But this stuff happens all the time. And it's just kind of the nature of the game there.
Well, markets
I think it's a good
are gonna market. I mean, honestly, I think that's what it comes down to. Like, these are freewheeling markets, and people are trying to find opportunities to profit on them. But yeah, Will, what were you gonna say, Will?
Yeah, just jumping back in there, Naomi brings up a great point. This kind of ties back to the high frequency trading and the whole Wall Street bets argument that was happening last month, where firms like Citadel can front run trades because they get the trades printed off from Robinhood before they're executed on Wall Street. And we're seeing the same thing in the blockchain world, but it's actually a little bit more dangerous because of how blocks are settled on blockchains. They take a really long time to settle. They take about 10 seconds. So everyone has a ton of time to see which transactions are coming in, as opposed to high frequency trading where it's sub seconds. So it's a little bit more dangerous here.
All right. Well, we're going to wrap it up there. Sorry, Ben. Hold that thought. Hold that thought, Ben.
It's okay.
Hold that thought for next time.
I will not do so until tomorrow, but we can move on.
Tomorrow. We can pick it up there. All right. Well, thanks so much for spending part of your Tuesday with us. It's Zach, it's Jen, it's Ben, it's Will, it's Naomi, it's The Hash. We'll be back tomorrow. Stick with us on CoinDesk TV at 3 p.m. Christine Lee talks all about Bitcoin. Should be a good one. All right. Talk to you soon. Bye.
Cheers.
Bye.